If you are struggling under a mountain of student loan debt, then today's video is for you. We're going to explore the 5 different income-driven repayment options, how it could save you money, and ultimately lead to a portion of your debt being forgiven. Hey team, I'm Dave. I'm the founder of Turning Point Financial Life Planning, where I use the tools of financial planning to help therapists grow their impact and build lives they love. If you are new here, please be sure and click on that subscribe button. So today we are going to talk about the 5 different income-driven repayment plan options for your federal student loan debt. There are 2 things I want you to take away from the conversation today. First, how much one of these IDR plans could potentially save you in monthly payments. And second, I want you to understand there are a fair amount of nuance and complexity in the differences between the 5 different IDR plans. So I want you to carefully consider which plan or which repayment plan you ultimately choose to enter into, because it will have some big implications for you down the road. That said, this is very complicated, so what I'm going to cover here is just a general educational overview. I could not possibly cover all the nuance and complexity around student loans and their different repayment options in a single video. So if you suspect you need professional help with this, please seek that out. I would really encourage you to seek out a fiduciary financial planner who has specific training in the complexities of student loans. I'm one of those fiduciary planners out there, and there are many other great professionals you could consider working with. I've included links to some of those professionals in the notes below. So the first question on your mind is likely, will I even benefit from one of these IDR plan options? And the answer to that is yes, if your student loan balance is greater than your annual income. And remember, if you're married, you want to disregard your spouse's income and just look at your own. Now, I cover all the details of calculating and how to think about income in my other video, the top 10 student loan tips I want every therapist to know. So go back and watch that if this is a little bit unclear. Now, if you are married and you want to disregard your spouse's income, you will need to file your taxes as married filing separate. And that is an unusual way for married couples to file their taxes. And it comes with some disadvantages. So you'll want to carefully work with your CPA or tax accountant to understand the downsides of that married filing separate status to be sure that they are outweighed by the benefits through your income-driven repayment plan. All right, so let's look at the first of the 5 income-driven repayment plans, and that is Income Contingent Repayment, or ICR for short. The main thing to know about ICR is that you probably do not want to use it. It will not lead to the lowest monthly payment in almost all cases. The one time you will want to use ICR or might want to use ICR is if you are a holder of Parent Plus loans, so plus loans that you've taken out for the education of someone else. ICR is the only repayment plan that allows Parent Plus loans, so in that case, you're stuck with ICR. If you want to read more details about ICR, click the link to my full blog post below and I'll walk you through all the details you need to know. The second IDR plan we'll review is Old Income-Based Repayment, or Old IBR for short. Main thing to know about Old IBR is probably you don't want to use it. Like ICR, it is not going to lead to the lowest monthly payment. There are better options. However, it is the only repayment plan that allows older FFEL loans to enter into it. So if you hold one of these older FFEL loans and you don't wish to consolidate into a direct federal loan, and that would allow you to access the other IDR options, then Old IBR will be the only option available to you. So click through to my blog post and I will walk you through the details of Old IBR if that fits your situation. Before we jump into the final 3 IDR plans, let's pause for a moment, if you can consider this a pause, and let's talk about unpaid interest and the capitalization of that unpaid interest. So what am I even talking about? So under these IDR plans, any of them, the idea is that the amount of your monthly payment is based exclusively on what your income is. It doesn't matter if you have 10,000 in federal student loans or 10 million in federal student loans, your monthly payment will be the same. What does that mean? That means that in certain circumstances, in a lot of circumstances actually, the amount of your payment won't even cover the interest that is accruing on your student loan. Now, that might sound terrible, and it is definitely a hazard, I guess, to navigate, but it can be good if ultimately that balance is going to be forgiven, you don't necessarily care. And the reason you don't care as much is because that accumulating unpaid interest, it doesn't increase your future interest expenses. It just sort of sits off in an account to the side. However, there are circumstances under which that unpaid interest will capitalize. And what capitalizing means is that it gets added to the balance of your student loans that is used to calculate the interest. This is a really confusing topic. The reason I bring it up is because each of the IDR plans, each of the different 5, treat unpaid interest and the capitalization of that interest a little bit differently. And those little bit differentlies can add up and make a meaningful difference. Getting into the nuance of all this is far too much for this video. I just want to flag the issue for you. It perhaps highlights the benefit, if not the necessity in some cases, of working with a professional to really carefully understand and even model out all the different scenarios and the financial impact of those different scenarios. So there is a lot going on underneath the hood of these different IDR plans beyond just what your monthly payment will change to. So just keep some of this complexity in the back of your mind as you begin to navigate and think through the best course for yourself. All right, let's return to the 5 IBR plans. We're on to our 3rd plan, which is New and Improved Income-Based Repayment, or New IBR for short. And I will keep this conversation short because, once again, New IBR, what you want to know about it is that you probably do not want to use it. IBR New, which we're talking about now, and Pay As You Earn, which we'll talk about next, are in many ways identical plans, but Pay offers one big advantage we'll talk about in a moment. Really, the only reason you'd want to use New IBR is if you don't qualify for Pay and you don't want to use REPAYE, which is the 5th and final IDR plan we'll discuss. All right, now we're getting to the really good stuff. Pay As You Earn and Revised Pay As You Earn are typically going to be the 2 most advantageous IDR plans for you to enter into. Under either one of them, your payments toward your student loan debt will be limited to 10% of your annual discretionary income. That is the lowest payment plan out there. And you might be wondering, how in the heck do I calculate that 10% of discretionary income? What are you talking about? Great question. Scroll down, click through to my free worksheet. I will walk you through how to calculate what that number actually looks like for you. Now, to be eligible for either Pay or REPAYE, you will need to hold a direct federal loan. As is often the case, FFEL loans, those older loans issued before 2010, are not going to be eligible. When we're talking about Pay specifically, there are some further nuanced requirements, and there are 2, and you need to satisfy both of those 2 requirements. First one is that as of October 1, 2007, you had no federal loans outstanding. Requirement number 2 is that you borrowed through a direct federal loan after October 1, 2011. I know, confusing, bewildering requirements. It is just what Congress came up with. Now, if you're not satisfying that second requirement, you can complete a consolidation, and that will count as borrowing after October 1, 2011. However, please keep in mind all the downsides that come with consolidation. If you're looking for a refresher on what those downsides are, be sure and go back and look at my previous video. 2 last things to know about Pay As You Earn. 1, after being in the repayment plan for 20 years, you will be eligible to have any remaining balance on your student loans forgiven. Now I know 20 years is a crazy long period of time, but it does offer some light at the end of the tunnel. Yet keep in mind that that forgiveness, the amount of debt you have forgiven, will be counted as taxable income. You will have to pay income tax on it down the road. So that law may change, but until it does, be sure and be saving for that tax bomb. The final thing to know about Pay As You Earn is that it offers some special treatment around the capitalization of unpaid interest. So that is that really confusing concept again. The important thing to remember about Pay As You Earn that is a big benefit is that the total amount of capitalized unpaid interest will be limited to 10% of your total student loan balance when you entered into the Pay repayment program. This limit on capitalized unpaid interest is an advantage, but there is a little bit of a downside with the Pay plan as well, and that is that that unpaid interest will automatically be capitalized up to the 10% limit as soon as you are no longer able to demonstrate a partial financial hardship. What the heck is that? All that really means is that your income has increased and crossed a certain threshold. If your income is likely to increase and you think that may impact you, be sure and click through to the main blog post where I will walk you through how to think about what a partial financial hardship is. All right, folks, on to the fifth and final income-driven repayment plan option, and that is REPAYE, or Revised Pay As You Earn. As the name implies, this is a modification or a revision to pay as you earn, so some of the provisions are going to be the same, but there are 6 important differences. The first difference is that, unlike pay, all direct federal loans are eligible for the REPAYE program, none of those funky timing requirements that pay has. Second, REPAYE will waive 50% of any unpaid interest you accumulate over the course of the year. Now, some of the other IDR plans, including PAYE, will offer this benefit for subsidized loans, but REPAYE is the only IDR program which extends that benefit to unsubsidized loans, and that can be a meaningful benefit. Third, under REPAYE, there's no cap to how big your monthly payment can grow to. Under REPAYE, you will always have to pay 10% of your annual discretionary income toward repayment of your student loans. And if your income grows substantially, so too will your required monthly payments. That's in contrast to virtually every other IDR plan, including PAYE, where there's a cap on your monthly payment. The fourth big difference, and this is a big one for married borrowers, is that under REPAYE, you can never exclude your spouse's income. You will always have to aggregate together the entirety of your household income to determine that monthly payment. And that is in contrast to literally every other IDR repayment program where you can file taxes separately and exclude spousal income. The combination of including spousal income and having no cap on payments makes it really important that you understand what your payment might be under REPAYE. Again, click through to my worksheet and I will walk you through that calculation step by step. Fifth, under REPAYE, if you have any borrowing for postgraduate education, and as a therapist I'm guessing you do, that will extend to 25 years, the period of time you need to be making payments before any remaining balance is forgiven. Sixth, and finally, there is no limitation on the capitalization of unpaid interest. If you'll remember, under PAYE there was a limitation at 10%, but REPAYE offers no such benefit. All right, after all of this, you are understandably likely wondering what is the best IDR repayment plan for you, and I am sad to say there is no simple answer to that question. What I'd encourage you to do is first access my worksheet and get a sense of about what your monthly payment would be under each of the IDR plans available to you. But don't stop there. Understand the nuances and the complexities around each of the different IDR plans, and you can do that by clicking through to my blog post or working with a fiduciary professional. There are some cases where you won't simply choose the lowest payment. There are other factors to consider. And finally, just as a reminder, please don't rely on representatives of the loan servicers to answer this question for you. They simply do not have the time, the resources, or the expertise to carefully think through which IDR plan option is going to be the best for you. All right, folks, that is a wrap. We have covered a lot of confusing ground today. If you have any questions whatsoever, please scroll down below, access one of those contact me links. I would be happy to answer any questions you may have over email. When it comes to student loans, this is perhaps the most complex and nuanced area of your financial life. So take the time, think things through, double check your work, reach out to a qualified and fiduciary professional if you suspect you need a little bit of professional guidance. Thank you so much for stopping by and spending some time with me here today, and I hope you have a great remainder of your day.